Hey everyone! Welcome back to the channel where we break down investing, ETFs, and market trends so you can build your wealth one smart move at a time. Today's video is a head-to-head showdown, SCHG versus QQQM, two of the most popular growth ETFs. Which one is better positioned for 2025? Should you stick with the tried-and-true tech-heavy QQQM or consider the diversified growth of SCHG? Make sure to like, subscribe, and stick around till the end because I'll also be sharing my personal pick for 2025 and beyond. First, let's quickly define what each ETF is. SCHG, Schwab U.S. Large Cap Growth ETF. It tracks the Dow Jones U.S. Large Cap Growth Index. It's home to some of the biggest growth stocks in America. QQQM, Invesco NASDAQ 100 ETF. Essentially a low-cost way to access the powerhouse NASDAQ 100 index, dominated by mega-cap tech. Both are growth-focused, but they differ in index tracking, sector exposure, and costs. SCHG top holdings: Apple, Microsoft, Amazon, Meta, etc. QQQM top holdings: Apple, Microsoft, Nvidia, Amazon, Meta. Performance-wise, both ETFs have crushed it over the past decade thanks to the dominance of U.S. tech and growth sectors. SCHG 10-year CAGR, around 14%. 15% QM NASDAQ 100 10-year CAGR, roughly 17%, 18%. In short term, both rebounded strongly in 2023 to 2024 after the tech slump of 2022. But QQQM's heavier tilt toward mega-cap tech has helped it outperform in bull markets, while SCHG offers a slightly more diversified set of growth companies. Let's talk about fees because costs matter in long-term investing. SCHG expense ratio is 0.04%, one of the lowest in the industry. QQQM expense ratio is 0.15%, cheaper than the original QQQ, which is 0.20%, but still higher than SCHG. Over decades, this small difference can really add up in compounding growth. So if cost is your top priority, SCHG has the edge. Next, let's look at sector breakdowns. QQM. Over 50% tech exposure, heavy in semiconductors, software, and cloud computing. It's supercharged when tech rallies but can be hit hard when tech falters. SCHG. Tech-heavy too, but more balanced with healthcare, consumer discretionary, and financials. Less volatile but potentially less explosive. In short, want concentrated tech? QQM. Want diversified growth? SCHG. Neither SCHG nor QQQM are income-focused ETFs, but let's quickly check the dividend story. SCHG. Current yield around 0.70%, 1.0% QQQM. Yield around 0.60%, 0.80%. Slight advantage to SCHG, but dividends here are minimal compared to total return. Growth investing always comes with volatility. Comparing. QQQM has slightly higher beta and volatility because of its tech concentration. SCHG offers a smoother ride with its broader sector exposure. In a bull market, QQQM tends to outperform. In market corrections, SCHG holds up a bit better. Think of QQQM as the high-octane version of growth. Here's how I see it. If tech and AI continue booming, QQQM is likely to outperform. Companies like Nvidia, Microsoft, and Apple are key drivers of AI innovation and digital transformation. If markets rotate toward other sectors, or if tech faces headwinds, SCHG could offer better balance and risk-adjusted returns. Also consider time horizon risk-tolerant sector preferences. If you're aggressive, QQQM. If you want steady growth, SCHG, my personal pick. I lean slightly toward QQQM for 2025 because of the unstoppable momentum in AI, semiconductors, and cloud computing. But I also hold SCHG for balance. If we see a sector rotation, with value stocks, healthcare, or consumer sectors leading, SCHG could shine. Geopolitical tensions, interest rates, and inflation will also play a key role. My personal view? I'm bullish on tech for 2025 thanks to the AI boom, so QQQM is my top choice. But I also own SCHG because no one can predict markets perfectly. You could hold 70% QQQM, 30% SCHG for tech-focused growth. Or go 50-50ths for balance. You don't have to pick one. Consider holding both for diversification within growth. What do you think? Are you Team SCHG or Team QQQM? Drop your thoughts in the comments below. Don't forget to like, subscribe, and hit that bell for more investing content. See you next time.